Right. Okay. Good morning, good afternoon, good evening to all of you. Welcome back to the next and the latest episode of the Trading Vault webinar series with VT Markets. If I could also just do a quick audio visual check, if you could please let me know in the chat box that you can see me, see my screen, hear me okay, that would be very much appreciated. Also, please do. Let us know where you're calling in from today, where you're dialing in from. Please let us know about your trading experience. Also, please let us know which broker, if you're not trading with VT Markets yet, please let us know which broker you're trading with. It'd be really interested to hear. I've been trading with VT Markets for several years now. They have great regulation, they have really tight spreads, and you can obviously sign up to and register with a live account through the QR code, which is on the screen right there now. And also in the chat, but there's a link to the to sign up in the chat box, where you can also enjoy promotions where if you refer friends to VT Market. So, right, Sweden. Hi from Sweden. Hi Jenny from Sweden. Beautiful Cape Town. Yes, Cameron, I have been to Cape Town. It is extremely beautiful, especially sort of like the surrounding areas like Stellenbosch and stuff as well. So, welcome to the Trading Vault from South Africa. From the Philippines, also another beautiful part of the world. I've done a lot of diving there. So, yeah, another beautiful part of the world. So, okay, great. It's great that you can hear me. It's great that you can see me. John from Spain, welcome from Spain, another European country I love. So all good. From Dubai, from the UK. Good. So we've got a really good mix from people all over the world. Right. Okay. So as I say, without further ado, let's jump into this and let's get cracking. As I say, great that you can hear me. Please do take the opportunity to sign up for a VT Markets account. Like I say, they've got some of the best spreads, some of the best execution out there, and they are very well regulated. So you can trade safely in the knowledge that you're safe in the trading environment. So. Um, Today's topic on today's Trading Vault episode is going to be about trading US indices. Okay, so we're going to talk about what moves US indices, what makes them slightly different from others, and how we can sort of trade them. Again, as always, we're going to sort of talk about sort of like a short presentation, sort of 15-20 minutes, then we'll jump into some charts. And look at some opportunities that are around at the moment and how we can take advantage of that. And also, obviously, if you've got any questions, we can do sort of like a bit of a Q&A and just sort of really be led by you. On that topic, if you could please also stay on at the end of the webinar. It would be very much appreciated to complete a short questionnaire and a short survey. It just helps us make sure that we can tailor these sessions to what you want to see from them and give you the education that you need from your trading. Okay, so. But today we are going to be focusing on the US indices. Okay, and again, whilst there are some very similarities around trading, the principles are the same no matter what asset class and instrument you trade. Different asset classes, different instruments have slightly different characteristics. So we're going to really be focusing on US indices today and what really drives them. So for those of you that are new to these webinar series, for those of you that are not and have been to these many times now, you already know who I am. But for those of you that are new, my name is Ross Maxwell. I am the VT Markets Global Operations Strategy Lead. It is my responsibility to provide high-level educational content for traders of all levels. So that's whether you're a beginner, whether you've been trading for several years now, whether you're somewhere in between. Hopefully this will provide some added value to your trading. I am a professional trader myself. I'm an investment manager, and I've been trading for more than 20 years now in the markets. It's actually 25 years this year, with a career that started in London and took me to Hong Kong. I am now an independent trader. I've been an independent trader since 2014. I'm also an award-winning trading coach and mentor, and a founder of Keyzone Traders, which is an online trading education company. So, as I say, let's jump into the actual presentation part of the webinar before we then start jumping into the charts. As always, if you do have a question, please do feel free to fire away into the chat box or the question and answer box. I will look to answer them as we move through. If it's something that can wait, then we will go to the end and do the Q&A. We want to try and make this keep on topic, keep as relevant as possible. And we can come back to any other questions at the end as well. So if I do miss a question, it will not be on purpose. I might be waiting till the end, and if I miss it, then again, I apologize. Please just do repost the question. I promise I will get it answered. So let's say US indices. So indices, as a general rule, not just US indices, but indices track the performance of a group of stocks. Okay, so different indices will be made up of different companies with the aim of giving the investor exposure to a different set of companies depending on the investor's objectives. Okay, and just so that you know, the FTSE 100 is the top 100 UK companies in the UK. You've got the S&P 500, which we're going to talk about, is the top 500 companies in the US. You know, if you want exposure to Indian companies, you would go to the Nifty. You know, so depending on where you want your exposure, depending on your objectives and what your views are, could depend on which index you want to actually invest in. So the US stock market is the world's largest and it's the most influential market. Okay, so when the US, a lot of other indices are follow or are influenced by what the US stock market is doing. It's a very key benchmark for global and investor sentiment. So, you know, they say when the US sneezes, the whole world catches a cold, right? So it's like whatever, even if the FTSE 100 struggles for whatever reason, that doesn't necessarily going to impact global indices. However, when the US stock market starts to struggle, that is going to have a knock-on impact into indices globally, and not just indices. It can have a knock-on impact into the wider sentiment across all asset classes in the market. So, US markets, as I say, influence global markets, currencies, and risk appetite across the globe. So it's a really, even if you don't necessarily trade US indices, it is going to be beneficial. It is going to add value to your trading to be aware of what they are doing and what is driving that move at the moment. Okay. And the guys have quite rightly put, did anyone notice that the US 500 has been making all-time highs? You know, the NASDAQ as well. And we're going to talk a little bit about what has been driving those moves into record highs despite the uncertainty that is going on in the world at the moment. So, as I say, traders will watch US indices to gauge market sentiment, economic strength, and institutional positioning. So, as I say, even if you do not trade the S&P 500, the Dow Jones, the Nasdaq, the Russell, if you don't trade US indices, it is still a good idea to monitor what they are doing so that you can see what the wider sentiment is in the market at that time. Okay, so there are four main US indices. Okay, there's the three really famous ones, and then there's the small cap Russells. Okay, so the Nasdaq 100, as I say, each one there's four main ones, but each one has a different objective. Each one makes up a different group of companies. Some companies belong to more than one, but as a general rule, if you want to invest in certain aspects, you would look to go to the index that most aligns with what you're trying to invest in. So let's go through what these what the each of them are made up. So the Nasdaq 100 is made up of 100 companies. Obviously, it's clues in the name, and these are mainly tech and growth companies, including major tech companies such as Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet. Okay, you would have all heard of these companies. These are the big tech giants, and these are what are actually driving the US markets to these record highs at the moment. We will cover that in a little bit as well. But NASDAQ, if you want to invest in tech, you go to the NASDAQ 100. The Dow Jones 30 is more diversified and is made up of more industrial and blue chip companies, including Goldman Sachs, JP Morgan, and Boeing. It does also include, as I say, Apple and Microsoft. Some of these companies can be included in two or three or multiple indices. The Dow Jones is where it's only made up of 30 companies and it's a weighted index. It can be more susceptible to movements dependent on the movement of one stock. But again, we're going to sort of cover this in a bit more detail shortly. The S&P 500 tracks the 500 largest publicly traded US companies and offers a broader benchmark of the US economy and is widely used by institutions and pension funds. So if you just want exposure to the US economy as a whole, then you would go with the S&P 500. If you want more sort of industrial blue chip exposure, you would go to the Dow Jones. If you want tech exposure, you would go to the Nasdaq. And then finally, you've got the Russell 2000, which tracks smaller cap US companies and reflects broader risk sentiment. So again, if you want to go for to target small cap US companies, that is the one that you would go to. Larger, broader economic exposure to the US economy, you would go to the S&P 500. Okay. So, guys, any questions on that at the moment in terms of US indices specific and the actual indices themselves? The US 30 is the Dow Jones 30, Eddie. So it's just so the US 30, generally speaking, is a ticker code that a lot of platforms will use. But the US 30 is the Dow Jones 30. You might see it as the DJ 30 as well, sometimes, or the US 30. Just like the Nasdaq can sometimes be shown as the US 100, and the S&P can be done as US 500. That is just the ticker code that you might see on a charting platform. But the US 30 is the Dow Jones 30. Okay, so the clue is in the number related to the number of stocks that make up that index. Okay, I hope that makes sense. Okay, so what are the differences between, for example, the Nasdaq 100 and the Dow Jones? Okay. The Nasdaq 100 is heavily weighted towards tech and growth stocks, as we've just mentioned, whereas the Dow Jones is price weighted and focuses on blue chip companies. Now, what we mean by price weighted is that whereas in some indices it's like an equal weighting, so each company will be make up an equal part of the index. The Dow Jones is price weighted, so the larger companies will make up a larger amount of the index performance and the index price. Okay, so those big sort of blue chip companies like Goldman Sachs would be more heavily weighted some of the smaller companies in the index, and therefore, the Dow Jones would be affected more, by the performance of an individual company if that company is heavily weighted in that index. So again, if you take one of the big index, one of the big companies within the Dow Jones, if they report really good earnings, the Dow Jones could rally um, more in terms of a comparison than if, like, one of the smaller companies has really good earnings because there's not an equal weighting. Okay. The Nasdaq has become more volatile and faster moving in recent years as tech has become the dominant driver. Okay, so you know I remember when the Nasdaq was as an index, the price was below the FTSE 100, and now it's like three times the size. We're pushing 30,000 on the Nasdaq. Okay, and we can have a look at the chart shortly. And the Dow Jones used to be the one that was more volatile. It would be like, move very, very quickly. But in more recent times, because tech is the dominant driver of the markets, and especially the US markets at the moment, the Nasdaq 100 has actually become more volatile and faster moving. Whereas the Dow Jones is more reactive, especially to sort of economic and industrial trends. And again, so the Dow Jones, if there is poor data that comes out, sort of poor economic data, which may impact interest rates or inflation or something like that. The Dow Jones, obviously the Nasdaq will react to that, but the Dow Jones may be more sensitive to that information because investors will still look to the Nasdaq to get exposure to tech, because they still see at the moment the growth in tech and the potential growth there, so they need to stay invested. So Dow Jones is now more sensitive to economic industrial trends, whereas the Nasdaq will be driven a lot more by sentiment behind tech. Okay, so again, all the time that we're seeing really strong growth, really strong investment in AI and in semiconductors and in tech, the Nasdaq is still going to perform and outperform other indices because investors want to be part of this next really big growth spurt on in tech. So, as I say, and also currently, due to tech leadership, the Nasdaq has a tendency to outperform other indices. And again, we can see this in the charts, which we'll look at shortly. But yeah, and this is the main reason that sort of the Nasdaq and the S&P have hit those record highs despite the ongoing issues with energy, potential inflation, like no clarity around future interest rates, the ongoing conflicts, global geopolitical issues. All of this creates uncertainty, which the markets generally dislike. But because of the potential for upside in tech and the potential growth for tech, investors are still pushing into tech. Okay, and again, we'll show this in a minute when we jump into the charts, where the Dow Jones has not performed as well as the tech because it is more impacted by all those geopolitical and macroeconomic issues, whereas the Nasdaq is pushed by tech, and some of those big tech names are also involved in the S&P 500. You know, it's a wider, broader uh, group of stocks which represent the US economy, which is the leader in tech and the advancement of tech and AI at the moment. Hence, that those indices are making record highs. Okay, what is the difference between stocks, individual stocks, and indices? Okay, so trading individual stocks only gives you exposure to a single company. It creates more concentrated risk. Losses and gains can be larger due to the performance of the company. If you invest in one of the big tech stocks, and that tech stock underperforms, whereas all the others continue to perform, if you're only exposed to that one individual tech stock, you are going to lose a lot of money. Whereas if you're invested into the Nasdaq as a whole, yes, there might be some impact, but as long as the other big tech stocks perform, you're generally going to make money. So it reduces your risk in terms of concentrated risk. It diversifies your exposure across a broader range and basket of companies, okay, by trading indices. It spreads the risk and reduces single stock risk. You can gain access to the performance of a sector rather than an individual company. So again, if you want exposure to the tech sector specifically, you invest in the Nasdaq. And indices often have better liquidity, tighter spreads, and high institutional participation. So institutions are there creating the liquidity, and we want to try and follow institutions as much as possible. Tighter spreads reduces the cost of execution, it reduces the cost of trading, and therefore can improve your edge and also make it easier to get in and out of trades. And due to the better liquidity that is on offer. And generally speaking, pension funds, institutions will invest in indices rather than individual stocks. Okay. Um, Indices and obviously indices can be impacted by macroeconomic news and economic data. So I've spoken quite a bit recent already in the session about tech driving the market. So if you've got any questions so far, please do feel free to post in the chat. We will get onto the charts very, very shortly. But as I said, big tech is currently dominating the markets and driving gains. AI, cloud computing, and semiconductors are driving those growth expectations. And that is why institutional investors are allocating heavily to tech to try and catch the gains that are expected from the advancement in tech in the years to come. Okay. So again, markets are very forward thinking. Okay. So what the markets are doing now, they're pricing in and investing in where they think tech and AI is going to be in the future, not where it is now, where they expect it to be in the future. But indices are heavily influenced by moves and strong earnings in companies such as Apple, Microsoft, and Nvidia, because those are the companies that are leading the tech advancement. And the Nasdaq has become less correlated to the Dow Jones and S&P 500 due to concentrated tech gains. However, because there are some tech companies involved in the S&P 500 and it's a broader exposure to the broader US economy. Nasdaq and S&P are a little bit more correlated, but the Dow Jones certainly is less correlated to the Nasdaq. So indicators that generally work well with indices, and these from my time. So when I was working in London and Hong Kong, I worked in indices. Okay, so that was I was equity derivatives, which was indices, futures, and options. And I know what the institutions look at, what indicators they actually use themselves to make their decisions. Okay, so we want to be using those same tools and looking at the same things that institutions are using. VWAP, which is the volume weighted average price. We have covered this in previous sessions, so I'm not going to go into too much detail about it today. Please go back and watch that webinar and a recording of that webinar. But institutions do use it as a tool to target fair value on execution of large orders, especially intraday. Okay, so they very much monitor VWAP and try and target VWAP for their execution and therefore defend VWAP if it goes back to those sorts of areas. Volume is used to confirm momentum and participation. Thanks, guys. So the webinar for the VWAP webinar that we did has just been the link for that has been posted in the chat. So if you haven't seen that yet and you would like to see about the VWAP webinar, please do click on the link in the webinar. And there's also a couple of links to articles around trading earnings and also an article around trading VWAP. Moving averages is another one that is used to help determine trend direction and overall market sentiment. And then finally, this is one of the key ways that I trade myself. And again, we've covered this in previous sessions. Use support and resistance to identify technical levels of institutional order flow and key price action areas. So when you have determined your direction, when you've determined your bias, when you've determined what you want to do, you can use these tools and these technical analysis skills, if I can get my words out, to identify the areas in the market that you want to be trading from. Okay. So finally, let's just talk about the fundamentals that could drive and impact the markets, and then I promise we're going to get into some charts. Okay, so fundamentals influence indices. Economic data releases like high impact data releases such as CPI, non-farm payrolls, and GDP. You can see the economic calendar, the high impact news, red calendar news in VT markets on their website in your user area. It gives you a list of everything that is coming out. You want to look for the high impact data that is economic data that is being released from the US. That is going to be what drives the US indices. Federal Reserve policy. So listen closely to commentary for future clues, not just the headline rate. A lot of people just look at the headline rate, and generally speaking, it doesn't change very often. Or if it does, it's sort of predicted in future, so it's already priced in. So the headline rate, in terms of the rate announcement, seldom, as in not very often, will move the market. It is the commentary from the press conference afterwards from the governor that will, and from the chair, sorry, of the Fed, that will give clues to investors and traders, and that will drive the market. That is what moves the market because it's telling us what they're thinking about they're going to do in the future. Not now, what is going to happen in the future. And as I said, is what is happening in what the market expects to happen in the future, which is what they try and react to. US markets are also heavily linked to 401k, which is the pension flows and long-term investing. So, you at the beginning of each month, you get retail pension flows into the US market. It is in the economies and the general population's interest and the government and the whole state of America. It is in their interest for US indices to continue to rise because their pensions are linked to it. Okay, and this is why you like Donald Trump. If you listen to what he talks about, he uses the strength of the US indices as a tool to reinforce that he is doing a good job on the economy. He uses it as validation to really confirm and to get into the minds of the the electorate that he's doing a good job and he's doing a good job for the economy because it's really important to America and to the electorate and to the general population that the stock market does well. Earnings season can create volatility, especially after hours when larger companies release their earnings. Again, there is that link to the article that the guys have kindly posted in the chat box around earnings season. Okay, so guys, thank you very much for listening to me. I've gone a little bit over than I would have liked for that sort of presentation, but there's a lot of information I think that we need to consider when we're trading US indices. So we're going to jump into the charts now. Is there any questions that you have at the moment? Is that all clear in regards to why it's important to understand what is going on with US indices? And again, please do fire away. Let us know who you're using. If you're already a client of VT Markets, that's great. Or if you are using someone else, please do let us know. The link to sign up for a VT live account is in the chat as well. And VT Markets have some of the best spreads, the tightest spreads, best execution out there in the market. Which is why I use them for my trading as well. So I'm just going to stop the share while I share my screen for the live trade or for the live charts. Okay. Okay, let's have a look. Okay, so hopefully you can see my screen again now. You should be able to see a screen which says S&P 500. Please let me know if you can see the question. Oh, sorry, see the chart. Make sure you can hear me okay. Perfect. Great stuff. Right. So, as you can see, this is an hourly chart, but you can see that the S&P 500, generally speaking, is in an uptrend. The Nasdaq, also generally speaking, you can see is clearly in an uptrend. The Dow Jones, however, very much more sideways, choppy price action. Okay, and again, this is where because the markets are uncorrelated, the tech stocks are still going to be very bullish. Okay, and if we go to a daily chart, um, if we can go to a daily chart, excuse me for a second. Okay, so this is the daily chart of the Dow Jones. Again, you can see that it has generally been performing well, but of late we had this big correction and we still haven't made new record highs. However, we look at the Nasdaq. Excuse me for the slow. Don't know, my system is running very slow this morning. Bear with me, guys, please. Sorry. Good question, Baz. What MA do I recommend? So personally, I generally use three moving averages. I use the 8 as a fast moving average, especially when I am day trading. I use the 20 as a general overall trend direction, and then I use the 200 as an overall trend direction. And again, the 200 moving average on the daily, I can tell you, is a moving average that institutions do monitor and use for overall trend direction. We'll come back to that in a second. But you can see here, this is the Nasdaq on the daily. Notice the difference that very, very strong when the Dow Jones corrected quite sharply. Yes, there was this correction, but not as deep. And look how strong tech has been since sort of end of March. We've seen this extraordinary rally on tech in the last sort of couple of months, even when the Dow Jones has actually struggled. It's recovered from a deeper correction. So again, it was more sensitive. It had a deeper correction due to it being more sensitive to those macroeconomic and geopolitical issues around energy prices, around the conflict in Iran. As soon as that sort of started to settle, it has recovered. But it is still a lot more choppy, whereas the Nasdaq you can see is just on this incredibly strong bull run. Okay, so that shows again the difference in visually within the charts. Okay, now looking at this again, so we want to try and buy tech, right? We know that tech is driving the market. We know that investors are still pumping money into tech. So we want to try and find areas in the market to buy from. Now, if we're thinking long term, a correction back to these levels here would be an extremely good opportunity to buy. So if we see a correction in tech, okay, so a correction in the US markets, that doesn't necessarily mean that the markets have all of a sudden, you know, burst and we're on our way down. But any pullbacks to retest these areas of liquidity, you can see the institution stepped in and sold here, they sold here. We've broken through. This is a great area around that sort of 26,000 to 26,300. That is the area that we would look to buy on a higher time frame, on a larger time frame context. Okay. Um, so at the moment, we really only want to be looking for buys on the Nasdaq because also we don't have any areas of resistance to look to sell. So if we're selling blind. Okay, we could, if we're a shorter time frame trader, look for lower time frames to try and get involved as well. Okay, we don't have to just wait on the daily time frame for pullbacks. So we can look as shorter term traders for more intraday areas to look to get long from. Just to cover. Uh, Abdullah will come to that in a moment if it's okay. We have actually covered those sorts of things in a previous webinar as well, so I won't go into too much about that, but I will cover that in a second. Um, and Keith, yeah, so Keith says, isn't this driven by AI and semis? Overall economic climate doesn't look great given inflation. And that's exactly my point that I've been making is that even despite the issues around inflation, interest rate path, policy decisions, the energy crisis. That's impacting the Dow Jones, but actually at the moment what is driving the market is tech, which is your AI, semiconductors, cloud computing, those sorts of things. Okay, the investment into AI and tech is incredible at the moment, and that is what is driving these gains. Okay, and then here, so if we're looking for short, so we don't always have to wait for this pullback here. We want to look for other areas in the market that could potentially look for opportunities to get long. We're not looking to short the market, okay, at the moment. We're not looking to short the market. We know that the market is bullish on tech, and therefore we want to try and take advantage of that. So we've got areas here of support. Again, we can see institutions pushed back here, came up, pushed back, broke through, came back, retested, pushed off. Okay, those are the sorts of things that we're looking for. We're looking for these areas in the market where institutions have stepped in before because those are the areas that institutions are going to defend again, even on pullback. So the idea at the moment should be to get long on pullbacks in US tech. Okay, so that would be one area. Um, you know, if at the moment we've got our all-time highs up here. Okay. Um, if it doesn't quite pull, let's have a look at this one here as well. We've had this reaction here from this area over here, and we've sort of had a reaction here as well. So if we start breaking below this area, we look to this area. If this now pushes on higher and continues with this big strong trend, and we start to see a breakout above that into new all-time highs, which we're seeing very, very regularly at the moment, then this area here becomes a good opportunity to get long on any pullbacks into the market. Okay, so again, if we're talking about trading, we're talking about if then. Okay, so if the market breaks out, then we can get long on a pullback into that area. But with something like this, you can just leave resting orders in the market. Depending on your trade plan, you could set an alert for this area. Again, on your chart, it's very easy to add an alert to your chart, wait for price to come down, and then look for a reversal pattern. Or you can just look to place an order where you go long around that zone. So you'd place an order sort of like around 27. Let's just there we go. We can place an order. It's just a risk percentage, so we only want to risk 1% of our account. Entry price at 27.6. We'll do 2.5 just to front run that zone a little bit. Stop. What have we got there? The zone to 27. So again, when we're looking at stops, we want to use the ATR. You can use 100% of the ATR, so you'd be about 150 points maybe. You can use a little bit less than that but you basically want to make sure that your stop is below that zone. But if we're using ATR, we can have 150 point stop, which in this will be 15,000, I believe. No, it'll be 150,000. No, excuse me. Let's have a look. We want 150 points, stop 65. Okay, we need a little bit of a wider stop on this one because the zone's a little bit wider. So, yeah, 300 point stop on that, something like that, around 7325, just below that zone. And we can target back up towards sort of like maybe this swing low here, or maybe even up to this next zone there. And again, you can see that's a 3-to-1 trade, minimum of a sort of like nearly 2-2R trade. And also when you're trying to get in something which has such a strong trend, there is no reason why we can't take partial profits around here or around here and let the rest of that run even higher, because we're getting into something on a strong trend on a decent pullback. That is when you want to start to leave 25% of your position to run. You've booked some profits, so you've reduced your risk exposure. You've not got any real risk in the market, and the potential upside is huge. Okay, so that is what I would be looking to trade on the Nasdaq at the moment. I'm looking for pullbacks into that area, or if we're going on to the daily chart, one that I would really, really look to be all over at the moment is a pullback into this area here, this 26,000 area. Um, Okay, the guys have put in another article there to read about the AI, the AI drive in tech as well. Apologies for the slow updates on my charts this morning, guys. Okay, yeah, so this area here, if we start to see a deeper correction, then that would be an area that I would be looking to buy from. 100%, I'll be looking to buy from that. I think, unfortunately, at the moment, this rally is so strong. I think the chances of pulling back to that at the moment are probably quite weak. It would have to be some sort of fundamental driver to get to see a pullback back to that. Whereas, okay, so that would be our approach on the Dow Jones, on the Nasdaq, right? So how should our approach differ for if we're approaching the Dow Jones, okay? Again, apologies for the delay. So we can talk about this about Abdul's question as well. So part of the fundamental analysis that drive the market, which we've covered a lot about in this webinar already around tech. Um, how about the market microstructure and order flow, like institutional traps, stop loss hunts, and the like? So again, we have covered this and how strategies on how to approach this in previous sessions. So please do go and check out the webinar recordings of the previous sessions, and we can talk about this. But we are still bullish on the Dow Jones. Okay, it is more susceptible to corrections. It is more susceptible to deeper corrections because it hasn't got the investment in tech behind it. But generally speaking, you can see that we are still bullish on US the Dow Jones, US 30. So again, we still want to look for areas to pull back to. Okay, so that's this area here. I would say is the best area. You had resistance here, pushback, breakthrough, support, strong push up, back through, support. Now, talking about your microstructures and the actual overall sort of stop loss hunting and things like that. Okay, this is where you can do you can do different things. It depends on how you approach the market and what your trade plan says. Okay, so I am very aware that stop hunting happens. Okay, again we've covered this. I'm not going to go into too much detail, but stop hunting happens. Liquidity, I call them liquidity grabs. Um, it's a natural function of the market. Okay, it's actually performing its function by facilitating trades by doing it. So there is every chance that this like the market could move down here, come to that area there, and then bosh, up it goes again. Okay, creating that liquidity grab, trying to take those stops that are in behind this swing low here, obvious swing low, and then it pushes up. So how do we mitigate that? We can approach it in one or two or three different ways. Okay, so we can either wait for price to come into that area, uh, and wait for it to take the liquidity and then create a signal which gives us confirmation that the liquidity grab has happened and then enter the market. Okay, that is one way that we can do this. We need to set alerts, we need to be patient, we need to wait for confirmation of the liquidity grab before we jump into the market. um, that is one way that keeps us safer. We're going to probably have a slightly higher win rate if we do that. The second is if we have really clear, obvious areas like we do with this one, just try and set a slightly wider stop to start with, just to protect ourselves against that liquidity grab. Once we've seen the liquidity grab, we can actually tighten our stop behind it, because once it's grabbed the liquidity, it shouldn't, generally speaking, does occasionally do like a double liquidity grab. I call it a fake out, but it generally should just carry on. So once you've got the liquidity grab there, then you can tighten your stop, reduce your risk exposure, and go with it again. Or you have to just accept that, it is part and parcel of trading. There's nothing against it. You're going to get better risk to reward trades. So you're going to get, if you always wait for that liquidity grab, you are going to miss a lot of trades. Okay, because you're going to miss every single one that just comes in, hits that zone, and pushes off. So you're going to get more trades. You're going to get more losers. If you get your risk to reward right and your execution right, you're going to still benefit from that edge. Okay, because we don't always, not in every single reaction, do we see a liquidity grab. So you have to just accept it as part of market function, and just mitigate and manage your risk around that, basically. Okay, so I hope that answers your question, Abdul, around that sort of institutional trap, liquidity grabs, etc. Um, and then yeah, so this would be the area that I would look to buy on the Dow Jones. We've got about another 15 minutes or so. So please do fire away with any questions. We'll have a look at this. We'll have a look at the S&P. We'll have a look at a little quick look at the Russell as well, and answer any questions you have. And then that should probably just take us up to the hour mark. If we're looking for lower time frames, okay, so again, we can see that we are a little bit more two-way price action on the Dow Jones at the moment, okay? And again, um, we probably need to be a little bit more aware of macro drivers when trading the Dow Jones, okay? We've got a clear area of resistance here, but we haven't really got any. We've probably got that area there as an area of support. So we are coming down to an area of potential support on the Dow Jones. And again, going back to your question, Abdul, if we're looking at this market, okay, so liquidity grabs, institutional traps, that sort of thing, generally speaking, happen more in consolidation phases where the liquidity is a little bit more two-sided, and we have these obvious stops. So actually, where we're in this sort of range, we're more likely to see a deeper liquidity grab than we are in a real strong trending market. So again, maybe you need to adjust your strategy that when, for uh, the Nasdaq, because we've got a really strong established bias, we're going to be more aggressive with our entries, and take the liquidity grabs as a hit when we have them. But maybe for a more range-bound market, you identify those areas, and that's where you wait for those liquidity grabs, where you're going to, wait for that confirmation, wait for the liquidity grab to present itself, maybe start with a wider stop and then tighten it once the liquidity grab has happened. Okay, so it's also about understanding the strength of the trend and the market structure that you're in that will allow you to determine the probability of, and again, trading is all about probabilities, right? So it would determine the probability of liquidity grab and when you want to be more aggressive and when maybe you want to wait for that confirmation or be a little bit more generous with your stops to manage your risk around that. Okay, so this area here would be an area that I'm looking for on the Dow Jones. Again, we've got resistance, push back, break through, pull back. Really strong reaction. We're developing this range. We still have an overall bullish bias on the Dow Jones, despite this sort of like strong sell-off since sort of Thursday afternoon. So we would be looking for the buyers to step in and potentially defend this area. Again, do you want to wait for that liquidity grab or do you just want to buy it? That would be up to you to determine your best strategy as to your approach, your objectives, and your trade plan. Okay. Excuse me, just got itch. So yeah, any questions on any of that, guys? So you can see how the difference in the way that you need to sort of approach the Nasdaq at the moment as opposed to Dow Jones because the drivers are very much geared towards the Nasdaq at the moment. Any questions, guys? Otherwise, we'll move on to let's have a look at the Russell first because it's slightly different to the S&P. The S&P 500 is very similar to the Nasdaq at the moment. So the Russell, as you can see, is a little bit more like the Dow Jones. Okay, so again, if we go to the daily chart, and just to prove the spread on, you can see how tight the spread is here on the small cap. It's only 0.4. That's really, really tight. VT Markets does have exceptional spreads. So again, if you are thinking of or looking for a broker, then I can highly recommend VT Markets for tight spreads and excellent execution. So as you can see, the Russell, the small caps, is a bit of a mixture between the Dow. It's a bit more of a broader sort of risk view of risk of sentiment in the market. Okay, we've got a bit more. It was a bit more susceptible to the pullback than the Nasdaq, the tech-heavy Nasdaq. And it has rallied more than the Dow Jones, which is very much driven by. So it's a very much a mixture. It's still being strong, but not as strong as the tech-heavy Nasdaq, but also stronger than the Dow Jones. So I would be looking to buy, this area here. If we go down to the lower time frames. I've got a question from Keith as well. We'll come to that in one moment, Keith, please. Um, you know, we've got an area here in the market that, where is it? Let's go to the 4 hour, might be a bit clearer to see. Yeah, here it is. So we've got an area here that I would be looking to buy. Again, really strong reactions from that overall bullish, and then you've got push down, come back, push down, breakthrough, retest, push up. This area here would be the key area in the market for me on the small caps. Okay, so all the time we create this bullish bias, that would be an area that I would be looking to buy from. Okay, so let's just take Keith's other question. Following up from my previous question, more of a future forward-looking outlook. Does there become a point where the tech valuations become way too overvalued, essentially leaning towards a tech AI bubble? Yes, that's a very topical point, Keith. We've been talking about this. Back end of last year, there were concerns that we was heading into an AI and tech bubble. If we go back and have a look at the Nasdaq at the back end of last year, you will see that there was some concerns around tech valuations, but every time, and again, the Nasdaq has priced in very strong, very aggressive tech valuations. Okay, there's concerns over the debt that some of these big tech companies are creating to invest in tech to push them to make sure that they stay ahead of the game and ahead of the curve. But you can see here, it wasn't huge, but you can see the corrections sort of back end of last year here. Okay, this was end of October through to sort of like end of November. So for a month, that was this push down was more to do with the issues around geopolitical issues in sort of like the Middle East and energy and stuff. But this pushback here was concerns around the tech valuations and a potential AI tech bubble. But every single earnings that has come out, they keep on performing. They keep hitting. They not just hit estimates, they exceed estimates. So all the time that the earnings and the growth and the outlooks keep performing so strongly, um, this market will still to continue to go up because the investor can only go on its information that it has rather than what it perceives to potentially be an AI bubble. If there are signs of the bubble bursting and they start missing valuations or start having to downgrade expectations, that is when you are going to start seeing a pullback in the Nasdaq. Okay. Um, which is why it's really important to view commentary, not just look at headline numbers. You want to look at forward projections because that's what the market is pricing in, not just the headline numbers. So yes, there is a potential at some point for the AI tech bubble, but whether that happens now or whether that happens at 40,000 or 50,000, we don't know. Okay, so investors need to make sure they get in on the value because I mean, again, people have been saying about an AI tech bubble from 20,000, and if somebody just went, oh no, there's going to be a tech bubble that's going to burst, it can't sustain these valuations, they would have missed all of this move. Okay, they would have missed all of this move. So from an investor's point of view, they need to continue to participate. They need to continue to invest all the time that the earnings are strong and the forward projections remain robust because that is what they need to get in on. Um, Only when that starts to change will there potentially be a bubble. But and this is the thing with tech, the potential for upside on tech and AI and semiconductors, cloud computing is exponential. We're at sort of like the beginning phase of something that is going to far outstrip the impact that sort of like the internet and that sort of tech revolution had on the world. So there is still, this that and that's what investors are saying is like the potential upside for this is so big that we need to continue to invest into it. Okay, so hopefully that makes sense. That doesn't mean to say there won't be a bubble at some point, but at the moment in the data it's not happening yet. Might happen next quarter, might happen in 3 years, 5 years' time. But at the moment, the data tells us that the tech companies are still producing strong earnings. They're still have strong projections, forward projections, and they're still investing in heavily into tech. Cool, brilliant stuff. Okay, guys, so we are coming to the end. Any questions, anything else that you would like me to cover before we call this a day today? Hopefully, you have found this extremely useful. Seen some opportunities there for trading to look to pull back on, some areas to look to pull back on. Brilliant stuff. Thank you, Jenny. Really appreciate the kind words. But other than that, like I say, please do stay on the call briefly afterwards to fill out that survey. It really does help us navigate and produce the content that you guys want and need to help you in your trading and to really add value to your trading. And as I've mentioned several times throughout the call, if you haven't already got a VT Markets account, I highly recommend doing it. The link to open an account is in the chat, as is the link to our next webinar. Please do sign up for that if you find these useful. But as I say, VT Markets offers some of the best spreads out there. Execution is fantastic. I highly recommend them as an execution broker. So please, if you haven't already, please do sign up to for a live account and continue to register. Come along to these webinars where we can hopefully add value and improve your trading results as well and performance. So the next webinar is on secrets of candlestick patterns, and again we can talk about go into more detail in terms of a few different candlestick patterns, but also understand that it is not a candlestick pattern that moves the market. It is the candlestick pattern that is your entry technique into the areas of the market that you should be executing from. So we're going to sort of tie that in, and hopefully that could even add some strings to your bow, some strategies, and some clarification on how to enter the markets using candlestick patterns. Okay, guys. So with unless there's any other questions, we will wrap that up there. As I say, please do register for the webinar. Please stay online to answer that survey, and also please do register for a VT Markets account. Hope you found this webinar useful. I really look forward to seeing you in the next one in a few weeks' time. Good luck with your trading. Please stay safe in these volatile markets. They are very interesting this year, to say the least. We're getting a lot of two-way volatility due to everything going on and the uncertainty around what's going on, which makes trading for me. I really enjoy those sorts of these sorts of market environments, but it can make it tricky as well. So make sure that you manage your risk properly. Make sure that you really nail down your risk management techniques and understand and have a structure around how you're managing your risk when you're trading. Right, thank you very much, Baz. Thank you very much, Eddie. Like I say, please stay safe trading, keep trading, be successful, and we'll see you in the next one. Cheers, everyone.